Hello traders, it's Tuesday, January the 14th. This is John Kicklighter, Chief Strategist for dailyfx.com. Here with your FX market wrap-up for the opening 24 hours of trade this week, and an outlook for what we can expect in the 24 hours ahead of us. This opening 24 hours was off to a strong start in terms of volatility, not necessarily capital markets, and that's because we had a pretty sharp decline in the S&P 500 and other equity indexes. This is a provocative move, one that would suggest that we could be stirring a deeply held but deeply stable trend in risk. All right, I've said numerous times before that I'm very interested in the scenario where we have a shift away from complacency that has set in for a number of months now and start to see something more dramatic on the sentiment or risk appetite front. If we can get a move towards risk aversion, all right, not necessarily risk appetite, but risk aversion, we'll have something far more meaningful to trade on our hands because there's so much more potential to the downside in a deleveraging than there is to building up a risk position from our current record or near record highs. So starting off our conversation for the week, and I did go into detail particularly on the risk side of things and how to measure it and what I'm looking for in today's strategy video, so do check that out. But this is the benchmark of what the risk move was for most of us, and I do like to use this S&P 500 as one of my favorite gauges for activity and sentiment. You can see here that this was quite a substantial drop. This was the biggest drop we have seen in 2 months. All right, actually have this measured out. This is changes, all changes over 1.25%. Whether up or down, and you can see that this was the biggest one since early November. So a very significant correction, but that previous one is not a very encouraging sign to compare to because that was a one-off decline that subsequently would revive to record highs. All right, this has actually been a pretty familiar sight with big declines, individual day declines, not necessarily lining up to momentum or the trigger of a downside move, but more so of an exhaustion drive. All right, this is going to be very important for us in establishing whether we are just getting one-off declines on volatile days or whether we are starting to build traction towards the bear side. Now, this is particularly important to me from a trading perspective. A lot of this is theoretical because I'll trade whether we have risk on or risk off, but it does lead to my level of trade in terms of how long I stick with positions, the level of exposure I'm willing to go for, because I don't like to go against prevailing trends without an abundance of evidence for very long or in very large size. So if I do see a risk aversion move, all right, and I have good confirmation of that risk aversion move, there is far more trades out there than I would know what to do with, and I can trade them in full size, more importantly. So, in terms of trading, I have taken a small risk aversion trade, dollar-yen, and the opening early hours of Monday. I did take this in the Asia session. We made that break, and you can see that break here on the 8-hour chart. This was a break to the downside of a neckline at about 103.80. Now, I took a short at 104.50, and I've set my, or 103.45, sorry, and I set my stop about 85 pips higher, so just above that previous break. It's not a very wide stop, but neither is it supposed to be because I don't want to try to fight a prevailing trend like this in any kind of large size. My position size is smaller, my stop is tight, and that is to control the level of risk I'm willing to go for. Now, I can absolutely build up this position or add in a risk-averse scenario, and believe me, there are plenty of options. Euro dollar dropping to the downside, pound dollar finally extending a move to the downside as the dollar builds up appeal, even potentially changing the tack on Aussie USD, even though it hasn't had a strong risk correlation. And that's all dollar-based, and the dollar, we'll talk about that in a second, with the severity of risk trends becomes a lot more attractive. But my exposure to the yen crosses, I don't necessarily just have to have dollar-yen. I can also go for euro-yen, a currency pair I've been advocating for a long time, and one of my favorite of the yen crosses. In fact, it was my favorite to short. I get that in a sense, one, because we're talking about its positioning relative, and you can see that just from a pure change perspective, benchmarking from when this run began in the third quarter of 2012, it is the most elevated and has the most room to correct. All right? Fundamentally speaking, we're talking about a relative position for monetary policy where the ECB is moving down the stimulus curve, right, and the Fed is moving up it. So that actually puts the euro at a disadvantage. All right? In other words, the euro-yen short side looks that much more attractive. But when I compare the recent relationship to risk trends, all right, so the Nikkei 225 futures at least had dropped off aggressively on Monday. Actually, the Japanese markets were closed on Monday, but the futures had dropped off. So what I was looking at was the correlation that we've had between these different yen crosses in that benchmark for sentiment. All right, now typically I like to keep this chart, dollar yen versus the Nikkei 225. We can see that relationship is actually quite strong for good reason, but it's strong with most of the yen crosses. So in comparison, all right, from a statistical point of view, I like to refer to this, something that I post in the real-time newsfeed pretty frequently. This is a relationship of the yen crosses to the Nikkei 225, so how sensitive it is in the short term, in the medium term, in the long term. All right. Oddly enough, look at Aussie yen. It is very poorly correlated over the long term to the Nikkei 225. So it's not a ideal risk aversion trade in all scenarios except the most aggressive risk aversion scenario. All right. But a lot of people I know are attracted to that technical pattern. But unless you really see high level conviction, which is difficult to come by, this is not the preferred, my preferred yen cross. And how about carry? All right, the actual carry trade. This is the kind of return that would offset any risk that we get in volatility. Well, you can see dollar yen is not attractive on that. Current carry is weak, and the yield differential is deteriorating. All right, you can make a stronger case potentially for the euro yen, but when you compare it with something like the risk sensitivity, it becomes a dual participant. So for now, in this transitory sense of risk trends, I like this dollar yen. And I'm not necessarily very confident in the risk aversion theme. Now, we could see risk aversion spill over, but we need to have a number of cues. I talk about those cues, and I will wrap them up pretty quickly or gloss over them so you can see more detail in today's strategy video. But I need to see more than just a breakdown, a short-term technical breakdown for the dollar yen. I need to see more than just a one-day drop from the S&P 500. So I actually created a new set of charts, which I call my depth charts, my risk depth charts. I'm going to go one stage beyond. All right. In terms of just general risk trends, the S&P 500 is a fantastic measure. I know this is a lot of lines. All right, the blue line is the S&P 500, but these are actually a couple other measures of risk and volatility. This is the orange line, the VIX. You're very familiar with that. You should be. This is the average true range. I tell many of you FX traders that this is a good alternative for implied volatility for currencies, which is very difficult to come by. It's a great substitute. And I also have a counter here. How many days has the S&P 500's average true range, 20-day average true range, been below a very paltry 10 points? All right. So this is a combination of measures where if you have one, it's very difficult to call it a contrarian reading. But when you have three and it gives you contrarian readings across the board, that's a little bit more convincing. So when I look at something like the extreme level of inactivity from a realized volatility perspective, and that is still extremely low, this is a one-factor measure. Right? And yes, it has called tops in the past, but it also has seen continuation in recent themes. But when I have a depth chart where I have multiple measures, that's when I get a little bit more encouraged that this is, or concerned, that this is a extreme and a contrarian reading. I've also pulled up this. This is actually the S&P 500, the blue line, but the periods of green here are when the S&P 500 has enjoyed an exceptionally high correlation to the UK 100, or the FTSE 100, the UK index, the DAX or the German index, and a couple of Asia indexes, including the Nikkei 225. So when correlation is high across global equities, in other words, we have a green line. Now this high level of correlation is a great measure of, one, proactive volatility, but also exceptionally low volatility in the early stages of a potential turn. You can see here a number of times that this is called turns. All right. Most recently, we had a turn at the tops of these three previous peaks, but it also has been a bottoming measure as well. So, keeping close eye on not just the first level S&P 500, or not just the dollar yen as a yen cross sensitivity, we've got to look deeper. All right, we have to see the depths of risk aversion really taking hold in these markets. All right. Now, one very important aspect to this is the U.S. dollar. We know that the U.S. dollar is a safe haven, it's the most liquid currency in the world, and when we get to particularly extreme periods of risk aversion, that's when the dollar steps in as its safe haven. All right? If we don't have severe risk aversion, if we don't have an extraordinary demand of safety, the dollar can actually maintain a pretty consistent correlation with the S&P 500, something that we have seen over the past year and a half in this chart here. All right? So this is reflected here in this dollar versus FX volatility index comparison. When volatility is dropping, fear is dropping, the dollar's appeal as a safe haven diminishes. All right? This is very important for me on my dollar yen trade. If the drop in the U.S. dollar that ended last week and started this week is the biggest contributor to this dollar yen decline, all right, then the dollar can stabilize very, very quickly. It's interesting because last week we did have this non-farm payrolls report. All right, and that non-farm payrolls report was certainly quite market moving. A lot of people were looking to this indicator as a potential gauge to suggest that the Fed would not be as aggressive in tapering. All right, this is the U.S. dollar index versus the non-farm payrolls releases over the past year and a half. Now, you can see that this was a big drop for the U.S. dollar. Wasn't necessarily a big rally for the S&P 500, however. We know that this actually dropped after a weak non-farm payroll showing. Now, we talked about the differences between this data and even some of the debate surrounding whether the data is accurate, and it really doesn't matter because it's what policy is being set on. And the bearings now are not what can make the Fed reduce its stimulus program, but what would be able to stop it from going forward with this QE tapering. All right, it's a change in momentum, it's a change in sentiment, it's a change in approach of the market. All right, now with the non-farm payrolls, if we were talking about a risk appetite appeal, we would not see the S&P 500 rise, but we could see the U.S. dollar hurt. All right, we need to see risk aversion kick in to the point where it's significant to offset the negative implications of a potentially slowed taper speculation. All right. This is a question that now comes into play. Where do we see the market really speculating on a continuation of taper, and when does it start to weigh on general risk trends? For this, in our depth charts, I think we need to look more closely at treasuries as well. This is the 10-year treasury chart, 10-year treasury yield chart. For those that don't know, yields actually move inversely to the price of the government bonds. You can see here this is the 10-year, and it had a huge drop on Friday. This is the 2-year, had an even more massive drop than the 10-year because this is essentially the time frame that the Fed is seen debating its monetary policy and the possibility of rate hikes. All right, so obviously that reduced any kind of near-term possibility or within the next 12 months of any kind of hike from the Fed. But when do we start to see the taper speculation? All right, or reflections of treasury yields changing in appetite for taper speculation, trying to front run the Fed and their taper timetable into a demand for treasuries because the market needs a safe haven. All right, treasuries are the market's preferred safe haven, or at least money managers and large institutions. So when do we trade off? Because this past session, we had a very sharp decline in the S&P 500. They also had a very sharp decline in the Nikkei 225. And if we have other indexes around the world follow suit, namely the UK and the FTSE 100 here, and other indexes that are just on the cusp, that we have a strong sentiment of risk aversion. That might encourage appetite for treasuries as a safe haven. Here we have treasury futures. So this is actually reflecting price. When the market starts demanding treasuries as a safe haven, this will rise and volume will rise with it. Right? Is this pickup a climb because the market's trying to price in more Fed purchases going forward, or is this pricing in appetite for safety? Same here with the ETFs, right? Treasury ETFs. Both of these are rising. This is a tentative sign, but it's one that we have to keep a close eye on. This risk trend consideration is important enough that it must always be in the forefront of our mind when we're setting our assumptions for medium-term trades. I haven't taken many medium-term trades. I don't have the opportunity to. All right? And that is because I'm waiting for these bigger themes to play through, and one of the biggest is risk trends. The opportunities would be great, and I know we've been sitting here on our hands waiting for it to occur, but it's worth being patient. Now, moving off of risk trends, and definitely risk trends is going to be important for me going forward with the dollar yen. And if I ever plan to make any new trades in the euro yen to the short side, the pound yen, the Swiss yen, certainly the Kiwi yen, all right, I need to have a greater degree of certainty in the risk theme. All right, but for dollar yen, I can also just look at the US dollar dropping, and that can occur as well if there is a drop in volatility. Now, that drop in volatility and a drop in the dollar is not that aggressive, and certainly not as sustainable. So I'm going to be very selective in whether to keep this trade, and certainly the requirement to build on this trade is going to be very, very high. But this isn't the only trading opportunity out there. Actually, I do have another trade that is on, and I managed to take the first target here. Aussie dollar or Euro Aussie short. I've been collecting the carry for a little while, but it finally hit its first target. That first target was about 175 pips. All right, so I had a pretty wide stop to begin with, but I hit that first target. Now we're at a more remarkable support. Previous swing high here, also a long-term 38.2 fib at about 150.40. Really, you can call it 150 even, but you can see it's tentatively held up here. This is a comparison between the euro and the Aussie dollar. All right, the risk implications are not that remarkable here. All right, if you had a risk aversion theme, euro and Aussie dollar would be under question. In fact, it's probably the euro that would be a little bit greater risk, and the euro Aussie would be supported to the downside. Interest rate expectations and current interest rates are both supportive of the euro Aussie to the short side, but the market has not fully integrated on that potential, and I think that that's where we have a greater opportunity for the euro Aussie. So I'm sticking with the second half of that position. Already hit first target, stop, trailed up to break even. But this is getting outside of that risk bearing. We can get outside of that risk bearing if we position for the fundamentals. All right. Now, under the concerns or under the possibility and opportunity that there may be a broader risk aversion theme, and I'm going to be very careful of this, I'm also going to be looking for other trades that might blur the lines for risk sensitivity, but also don't necessarily require risk aversion to kick in. I am more interested in the pound dollar this week than many other currencies, and I've been watching this one for a while. It has been very restrained. It hasn't really played through on the potential that it offers, but you can see this congestion pattern, and certainly starting to turn more into a head and shoulders pattern. If we break to the downside, first being this, actually this is a 39 EMA, but if we break to the downside and really clear the 162.50 floor, we have a greater potential. Now, as I said in weeks past, the pound dollar is not as sensitive a risk currency pair. This is not like a euro yen or a pound yen. All right, this is not one of those currency pairs. This is very much sensitive to the interest rate forecasts and current monetary policy bearings. So when I look at the, let's say, 2-year yield differentials from the UK and the US, this is what's more important. The rate forecast for the UK versus the US, that's what's more important. Well, in assessing this monetary policy expectation, obviously Friday was not a very encouraging day for the taper and the timeliness of the Fed's shift from taper into a rate hike. But we will see that the pound is going to weigh in on this balance itself in the upcoming session. And we will have some U.S. event risk that can do more damage itself, whether that's bullish or bearish. It depends on what side you're on. But for the UK, for the British pound, if you're trading any pound-based pairs, and this is going to be important for all pound-based pairs, watch the inflation data round. Right, 9:30 GMT. This is a very significant round of inflation figures. This is where we start to see whether there is indeed justification for the Bank of England to move earlier on interest rate hikes than they have recently suggested. The market has been consistently moving against the possibility that they are going to wait until 2015 to do the first hike. We see a lot of premium actually built up into a late 2014 rate hike. This is why we have such a strong showing for the pound over the past 6 months. All right. Now, if this comes out to be disappointing, we're going to see yet another piece of data that undercuts the possibilities of that early rate hike. All right, and that will diminish the yield behind the British pound. If we see that occur, the data weak, and the pound dollar take a move to the downside, that is going to be an attractive setup. The dollar will have its own issues, which we will consider when we're there, but keep it in mind for the pound dollar. Keep it in mind for something like a euro pound. All right, the euro pound's already starting to rebound. The pound's starting to pull back more aggressively here, but that could be potentially a pound dollar long after a rebound. But we also have pairs like pound kiwi, where the pound has dropped off this tighter channel here and made new progress to the downside. 195 is another important level. If the pound rate hike forecasts diminish further, the kiwi has plenty of yield expectation that it can continue to drop. Pound Aussie, similar situation, and this was a break on a head and shoulders pattern. Looks a lot like those yen crosses. All right. Testing former support as new resistance depends very heavily on these fundamentals. If we do get into a very serious risk aversion theme, though, be very careful of Aussie and Kiwi pairs. They can end up being very much a sleeper risk-sensitive currency pairing. All right? But the pound is going to be able to run on interest rate expectations, especially with the upcoming data. You just have to be able to pick your pair properly. And I think pound dollar, pound Aussie are probably two of the better pairs from that perspective. Now, for the US dollar, as I said, I think we're going to have to be watching risk trends pretty closely. But unless we actually get into the full-scale risk theme, a couple things to watch. Data, retail sales, small business confidence, as these are the biggest employers of Americans. We have the start of the second quarter earnings season, especially for the financial sector. And I think the most important thing to me is going to be two voters, Plosser and Fisher, known hawks, who are going to be speaking on the economy. Watch their commentary. They can lend themselves to this ongoing taper debate, especially at the non-farm payrolls. And if they do offer us some hawkish commentary, it will certainly thwart any kind of expectations that taper has been derailed by the weaker employment figures. If that's the case, and this continues to drop, and the dollar starts to level off, we have a more clear risk theme. All right? As we go forward, there's a lot more event risk throughout the week, but these are the kind of themes that we need to keep involved in. Risk trends and taper considerations, because that's where a lot of our expectations are. We can talk about a risk-sensitive yen cross, whether the dollar yen or whether the pound yen or euro yen, but we can also talk about relative monetary policy, particularly from the taper and the dollar side. Euro dollar, if you want to get out of this congestion band that we've had recently, all right, and it's certainly it's synced up. If we can get below this 136.30 level, then we can potentially get a little bit further down, maybe even continuation. And it will certainly play into a pair like this, dollar yen as well. This is actually at the center of both themes, and this is why I'm watching the dollar yen so closely. All right, lots of opportunities out there, but we have to wait and see when they truly follow through and get that momentum. Otherwise, they're going to be short, very consistent trade setups. All right, be in and out and be very objective in the way that you trade them. You don't want to be committed to anything that does not want to commit itself. All right, so we'll keep a close eye on these markets. I have a couple of trades on, but they have yet to really generate momentum. They really depend upon these themes: relative monetary policy and risk trends. Good luck trading out there, guys, and I'll update you once again on these markets tomorrow.